there. My name is Trevor Atkinson, and I will be presenting my task today.
Now, I'll briefly provide an overview of the case. The Hops and John. The company is a transportation service similar to a taxi or the new companies such as Uber and Lyft. They are based in Des Moines, Iowa, and operate within the downtown district. They also have 3 lines of service. So the first one is Hop, and this one is a close proximity service, and it operates within a 5-mile radius of downtown. And then there's Scope, which provides a 15-mile radius reach for anyone going to the outskirts of the city. And then finally there's Jump, which specifically goes to the airport and back to the major employers in the downtown area. It is also important to note that this company used the debt market rather than the equity market to fund their business. However, they still owe a large number of loans to banks, so they have some financial pressure to meet the loan requirements. It is expected for them to give non-audited financial statements every quarter and then an audited financial statement at the end of the year to these banks. And the expectation is that they keep their pre-tax income above 0. Finally, it is my goal to offer a new analytical insight into this company and to audit the high-risk areas such as the sales account. I will now begin by speaking on data analytics. Generally speaking, technology offers many new avenues in which auditors are able to increase both their audit quality and the audit capacity. One of these new technologies is big data. Big data is able to expand the original scope of the audit by adding valuable data from outside sources, and this can lead to further comparisons and conclusions for the auditor in order to improve their analysis of the client's transactions. While data analytics has been a more utilized practice for a longer period, it can still be just as impactful for auditors. Data analytics enhances the audit by facilitating a more thorough risk assessment through identifying patterns or irregularities in comparison with historical client data and industrial data. Other new technologies such as RPA and blockchain can help auditors remove otherwise mundane work, and it frees more high-level work and also more analysis of the data. Traditionally, management is somewhat hesitant to trust in technology, performing duties that are normally done by a person, but oftentimes they are even more reliable and have less of a time constraint that a human does. This is backed by the decrease in errors and the increase in availability. For instance, in RPA, the bot can flag any transactions which is outside the parameters set for the scope of that account. Generally speaking, technology offers many new avenues in which major advantages to auditors embracing these new emerging technologies. However, with everything comes a trade-off. Each one presents new risks that result from implementation and ongoing maintenance of these technologies. The risks span anywhere from reporting to operational risk, and it is the responsibility of internal and external auditors to monitor their use. Beyond risk is the actual implementation of such technology. This will require auditors to extend their technological acumen to better understand these softwares, and it also means that training and continuous education will be essential for auditors to keep pace with them. With this comes fear of change and resistance to change. Many people who see new technology see it as a threat to their job, and it's just a fear. For the most part, these fears can be whelmed by people fully understanding the technology and bettering themselves so they are able to use it in the future. Data another issue with the data is how it's collected and analyzed. Auditors must be mindful of what data they gather, since it is very important for them to give meaningful insights to the client. One such of product reporting would be within the cash flow. The driver's top stock up are similar to a taxi or any of the other modern ride-sharing services, and consequently, they will be tipped for their services by the passengers. And if the company takes a percentage of these tips, it would be considered vital to focus our scheduling on the accurate reporting and controls involved in tracking the tips earned. Another area I would focus my attention towards would be any larger than average accrual accounts, as the pressure from loans owed to the bank might create an environment that's more susceptible to earnings management. These sorts of accounts allow managers to use their own discretion within accounting methods to potentially move earnings in the desired direction to reach performance goals and expectations. Lastly, I would assume the sales account would be high risk, since the revenues of 2020 were higher than in 2019. As we all know, in 2020 there was a pandemic, and with the restrictions on traveling and shutdowns, it seems suspicious that there is an increase in sales revenue rather than a decline. Using the background and knowledge that I have developed from my time at USF with Tableau, I would first start by creating a table of sales transactions and their corresponding dates. Then I would filter for dates outside of the current period, and then by further analyzing, I would disaggregate the sales data into each service line. From there, I would organize the data into a horizontal bar chart with tick marks of the prior year total overlaid on each row. This would be so that I can see the change from last period to this period. After this, I would use the NOAA weather data to look for days where weather is a factor on the sales. I would create groupings for each type of weather. Days without weather should have average sales. Days with moderate weather should have above average sales, because more people obviously are willing to take the taxi to stay out of the rain and snow. And then days with severe weather should have below average sales. Then, by showing each day's weather and sales, I would be able to find patterns or anomalies of unusual sales data in accordance with the date and the weather that happened or occurred on that date. Oftentimes, large portions of senior management salaries are tied back to how the company performs financially. Normally, these compensation plans, which are created by the compensation committee under the board of directors, are linked to an earnings number goal, or it's based on a specific margin compared to last year's results. This gives managers high incentives to achieve whichever target they may be falling just short of. In the case of an annual bonus, managers will be enticed to adjust any reserve account, a discretionary accrual, or possibly even the federal income tax provision in order to beat or just meet the expected goal. Furthermore, with the assumption that management consistently pushes the numbers to just meet the expectations, the stock price will continue to rise unless investors become suspicious of this. This serves the interest of management, since the climbing stock price will ensure that when they exercise their stock options, there will be a guaranteed gain in place. One note I would make is that when there is a strong compensation plan for senior executives, normally the audit committee should be increasing their strength by monitoring further to make sure that management is not going too far with their assertions in the financial statements. The auditor clearly plays an important role by examining management's assertions in the financial statements and attesting to the validity of its contents. However, I would argue that there are other parties who play an even bigger role in constraining earnings management. First, the board of directors holds a responsibility to be the voice of the investors and represent their interests. The board is able to monitor management by ultimately being the entity that oversees management's decisions. Similar to an auditor, a strong board would be made up of mostly independent people, and these people should possess expert financial, managerial, and industrial knowledge. Another occupation which directly impacts constraining management from earning or managing earnings too much would be the internal audit function. The mission of internal auditors is to add value to the organization by achieving operational and reporting goals. Internal auditors play an integral role in developing and maintaining efficient controls, which help to mitigate risk and create a smoother workflow. Finally, and often overlooked, financial analysts have a primary role in constraining management. For starters, analyst compensation comes directly from how accurately they project the firm's earnings. So they have a level of independence which none of the other parties do, in that they are not economically tied to the company. They receive their money from investors and those who pay for their services. And adding to this, it is clear that the analysts make their money based on their prestige and expertise in an industry. So an analyst has no incentive to damage this in any way. Additionally, analysts are given inside information into a company's finances that are not shown to investors. So with this inside information, they are better prepared to spot earnings management. So, auditors need to embrace new technology as it elevates the audit by providing new analyses and insights which may have been undiscovered before. Auditors can address the new risk introduced by further understanding and practicing with these softwares, and this can be fulfilled through continuing education of these topics. Data analytics and visualizations can identify trends and anomalies which would be much harder to find otherwise. The example of using big data of weather and financial data of the company shows that it can enhance the audit by digging deeper into areas of presumed fraud risk. Compensation plans can obviously create negative incentives for management to manage earnings for the hopes of cashing in a stock option or getting a new bonus. But with the increase in monitoring from the audit committee, this should be negated. And finally, auditors are not the only ones who constrain management's actions. The board of directors, internal audit function, and financial analysts all help keep management within the lines of GAAP. Thank you for the opportunity to present and graduate from this great school. I hope you have a good summer.